Welcome to Balance of Economy. Before we dive into the data, please note that this is market research for educational and informational purposes only and does not constitute financial advice or a recommendation to buy or sell any asset. Let's look at the numbers. Welcome to the debate. So, right now, in Washington, D.C., late-night pizza deliveries to the Department of Defense have surged by an astonishing 434%.
Ah, the classic Pentagon Pizza Index.
Exactly. And historically, it really means one thing. Geopolitical tension is spiking, and the military apparatus is essentially burning the midnight oil, preparing for a crisis.
Yeah.
But what makes this moment truly fascinating is how digital assets are reacting to this really dark macroeconomic picture. I mean, we are staring at a completely fractured market right now.
Fractured is putting it mildly.
Right? Like 92% of people who bought Bitcoin in the last 5 months are currently holding at a loss. And institutional ETF outflows have reached $173 million in a single day.
Which is the absolute definition of a warning signal. I mean, you have massive institutional outflows occurring exactly as the geopolitical environment darkens.
Right. Especially highlighted by those reports that Iran and Oman are drafting a strict protocol to monitor traffic through the Strait of Hormuz. We are seeing real-world macroeconomic stress just instantly pricing into these digital assets.
Which honestly frames the exact structural question we are examining today. In the face of this severe macro volatility and, let's face it, obvious technical weakness, do the data and market structures support a strategy for selling, meaning de-risking and capitulating, or a strategy against selling, holding and accumulating for the long term? Well, we know where we both stand on this.
We do. I am taking the position against selling. I view this current volatility not as a structural failure, but as a standard cyclical shakeout. It's really a rare accumulation opportunity before a massive, unprecedented wave of institutional, defined contribution flows fundamentally alters the market's liquidity.
And I am taking the position for selling. The market is breaking critical technical support levels right now, and the severe macroeconomic headwinds we are facing have just fundamentally invalidated the historical cycle models. The ones this industry has blindly relied on for the past decade.
Blindly is a strong word.
Well, it's true. Holding through a structural breakdown is just a recipe for catastrophic capital loss.
Let me lay out why selling right now is frankly a classic, emotionally driven retail error. We have to look at this through a structural framework, specifically Michael Turpin's 4-year cycle model.
Right, the seasons.
Yeah, exactly. He identifies the phase we are in right now as the Bitcoin fall. For those unfamiliar, the cycle usually follows 4 seasons. You have the pre-halving spring, the immediate post-halving summer run, the brutal mid-cycle correction known as fall, and finally winter.
And your argument is that we're just safely in autumn right now?
We are in the fall. Yes, it happens every 4 years like clockwork. Retail panics, the fast money leaves because it lacks patience, but the long-term thesis is actually strengthening behind the scenes.
How so?
Look at the mechanics of what BlackRock is doing right now. They are not just offering an ETF. They are actively building the infrastructure to introduce Bitcoin and Ethereum into standard 401k plans.
Sure, but...
And to understand why that matters, you have to look at how Americans invest. Right now, only about 25% of the population, those in defined benefit plans like, state workers or teachers with pensions, have institutional access to alternative assets.
Okay, fair.
BlackRock's move is going to level the playing field for the 80% of Americans who rely on defined contribution plans, where the employee directs their own capital. That is an automated, biweekly structural wall of capital that is coming, and that happens regardless of what the Pentagon Pizza Index is doing today.
I'm sorry, but I just don't buy that. Let me tell you why. That is a very clean theoretical model, but it completely ignores the brutal reality of the tape right in front of us.
The tape is noisy right now, I'll give you that.
It's more than noisy. The current market structures demand immediate de-risking. You cannot ignore the severe on-chain and technical realities. I mean, Bitcoin has repeatedly rejected liquidity zones right around $69,000.
True.
And a liquidity zone isn't just a psychological barrier, right? It is an area where massive amounts of supply are sitting, just waiting to be dumped on any buyer who steps up. And right now, we are hovering above the absolute last line of defense at $60,000.
The 60K level is definitely a psychological anchor.
It isn't just a random number, though. If we see a confirmed break below $60,000, billions of dollars in leveraged long positions will be forcefully liquidated by exchanges. That cascade opens up catastrophic technical downside targets of like $52,000 and eventually $45,000.
The liquidation cascade is a known risk, yes.
And regarding this highly touted institutional adoption you mentioned, it has merely introduced flighty, retail-like panic into the ETFs. These ETFs are actively bleeding capital in response to the exact geopolitical shocks we're seeing. The data simply does not support holding blindly into a macroeconomic storm just because a theoretical calendar tells you it's, quote, autumn.
I see why you think that, but let me give you a different perspective. I understand the anxiety around those technical levels, but we have to look at the mathematical resilience of the 4-year halving cycle.
The halving again?
Yes, the halving. We are currently about 1,600 blocks away from the exact halfway point to the 2028 halving. Historically, buying this specific fall phase yields outsized returns. I mean, if you look at the last cycle, buying the 2022 lows leading into 2025 generated an 8x return.
Okay, but...
And I want to explain why that happens, because it's not magic, it's mathematics. The supply issuance cut is immutable. The network is now only producing half the daily supply it was a year ago.
Right.
So when you cut the incoming supply of any commodity in half, as long as long-term demand remains even slightly higher than that newly restricted supply, the price is mathematically forced to appreciate to find a new equilibrium.
The problem with that argument is that you are treating historical cycles as immutable laws of physics. In reality, these 4-year cycles have been, frankly, statistical anomalies occurring entirely within a zero interest rate environment.
I wouldn't call them anomalies.
Well, for the last 10 years, money was free. Of course, an engineered supply shock caused the price to explode. But the current macro environment is entirely dominating the tape now. Look at the traditional debasement trade.
Gold.
Yes, physical gold is pumping heavily right now as a direct response to sovereign debt stress and geopolitical fear. If Bitcoin were truly acting as digital gold in this cycle, as the core thesis suggests, it should be front-running that debasement trade.
Not necessarily front-running it.
It should be catching a massive bid as the Middle East destabilizes. But instead, crypto's correlating tightly with the tech-heavy S&P 500 sell-offs. When the stock market drops in the pre-market, Bitcoin dumps with it.
Temporarily, yes.
It is acting as a high beta risk asset. And by high beta, I mean it amplifies the stock market's movements. If the S&P drops 1%, Bitcoin drops 3%. It is trading like a volatile tech startup, not a safe haven.
I would argue it is acting as both, actually, but they operate on entirely different liquidity timelines. Let's unpack the gold versus Bitcoin dynamic, because it is crucial.
Sure.
Think of physical gold as the emergency brake in a car. Central banks, sovereign wealth funds, massive institutions, they pull it the absolute second they see a crash coming because it is the oldest, most established safe harbor.
Right, it's the knee-jerk safety play.
Exactly. Bitcoin right now is more like the airbag. It does not deploy the millisecond the brake is pulled. It deploys a moment later when the actual systemic impact, fiat debasement, hits the dashboard.
Okay, an airbag. That's an interesting analogy.
When governments inevitably print more money to cover the costs of these geopolitical escalations and, supply chain disruptions, that liquidity flows down the risk curve. The debasement trade will capture Bitcoin, just as it always has. Gold moves on the fear of the event. Bitcoin moves on the monetary expansion required to pay for the event.
That assumes the buyers who eventually step in are permanent, conviction-driven holders. But let's look at who is actually moving the market right now. We just saw a $173 million single-day outflow from Bitcoin ETFs.
Yes, the proxy flows.
And over on the Solana side, we have seen a 5-day negative outflow streak. This so-called institutional money that was supposed to stabilize the asset class, the people who bought the ETFs, are acting exactly like panicking retail investors.
I mean, they essentially are.
They are logging into their brokerage accounts and dumping their bags the second a headline about the Middle East crosses their terminal. That is not a foundation you can confidently hold through a 30% drawdown. You are trusting flighty capital to act as a structural floor.
Well, no, you are conflating ETF proxy flow with true permanent capital. The ETF buyers are, as you correctly pointed out, essentially traditional retail and mid-tier institutional investors using a familiar brokerage wrapper.
Right.
They will almost always panic sell the bottom and panic buy the top because they are reacting to headlines, not network fundamentals. But if we pull back and look at the actual permanent capital, the picture is completely different.
How different?
Michael Saylor is methodically executing an ongoing march toward acquiring 1 million Bitcoin for MicroStrategy's corporate treasury. They are buying the exact dip the ETFs are selling.
Saylor is a unique entity, though.
Furthermore, on-chain data just showed a Satoshi-era whale wallet waking up to buy 12,000 Bitcoin this week. And it is not just Bitcoin. On the Ethereum side, the structural institutional integration is deepening. Robinhood is not just holding Ethereum, they are actively launching a customized EVM Layer 2 network.
I did see that.
Day to settle. That is the T+1 settlement issue that causes immense counterparty risk in traditional finance. By building on an Ethereum layer, Robinhood is trying to turn that 24-hour delay into an instant, cryptographically secure settlement using real-world asset tokenization.
Which is great tech.
It is permanent, sticky infrastructure being built directly into the core of U.S. equities during the precise time you are suggesting people sell.
Look, the Robinhood development is genuinely fascinating from a technological standpoint, but we need to look at the behavior of actual crypto-native public companies right now. If permanent capital is truly acting as an impenetrable floor, why are major crypto-native public treasuries, like Riot Platforms and Embridgery Digital, actively liquidating their Bitcoin holdings?
Well, that's an operational issue.
These are the mining entities that ostensibly understand the underlying technology, the network hash rate, and the 4-year cycle better than anyone on Wall Street, yet they have fully exited or severely reduced their positions.
Wait, let me stop you there.
When the miners and the native digital treasuries are distributing their assets into the market, it tells me that the internal risk models of the smartest players in the room are flashing red. They are selling to preserve capital because they see the technical breakdown coming at $60,000.
Let me stop you there, because the mechanics of why miners sell are highly misunderstood. They are selling to fund operational expansion, which is an entirely different mechanism from a loss of faith in the asset.
Selling is selling on the order book.
Yes. But let's break down what a halving actually does to a miner. 4 months ago, a miner received 6.25 Bitcoin for solving a block. Today, they do the exact same amount of intense computational work, burning the exact same amount of electricity, but they only receive 3.125 Bitcoin.
Right. The revenue is half.
Literally cut in half overnight. But their dollar-denominated expenses, electricity, real estate, cooling, they remained exactly the same. So to survive, they have to liquidate their treasury reserves to buy next-generation hyper-efficient ASIC mining rigs to remain competitive.
Sure.
That constant upgrading of hardware is standard operating procedure for a mining business post-halving. It is an operational necessity, not a structural capitulation or a bearish macro call.
But that operational selling by miners exposes a much darker reality about the network itself. Standard operating procedure or not, it introduces massive sustained sell pressure right as we teeter on the edge of that critical $60,000 support.
It is pressure, yes.
If miners are forced to dump just to keep the lights on, it strains the market's liquidity. And this brings us to the immediate execution risk and systemic fragility of the network infrastructure itself. Technical models that predict an 8x return completely ignore the reality of holding these assets in a hostile environment.
Hostile in what way?
Beyond the precarious price action, look at what just happened on Solana. The Drift protocol, a major decentralized exchange, was exploited for $26 million by North Korea-linked entities.
That was an unfortunate smart contract vulnerability.
Unfortunate, yes, but you can be entirely right about the 4-year macro cycle. But if you are passively holding your tokens in a smart contract while state-sponsored hackers are actively draining the decentralized plumbing of the ecosystem, your personal return is zero. The structural risk of the infrastructure right now is simply too high to hold passively without de-risking your portfolio.
I disagree on the overall fragility of the infrastructure. In fact, the structural plumbing is exactly what is maturing right now, and the underlying network utility is completely decoupling from the short-term price action.
Decoupling?
Yes. Vulnerabilities at the application layer, like the drift protocol exploit, are painful learning curves for the industry. But look at the base layer volume of value transfer. Stablecoin monthly volume just officially surpassed traditional ACH bank transfers for the first time.
That is a big number.
It is an astonishing milestone. More value is moving across cryptographic rails right now than through the traditional automated clearinghouse systems of legacy banks. We also have the passage of the Genius Act, which legitimized stablecoins at the federal level.
And the Clarity Act.
Exactly. The intense anticipation of the Clarity Act, which aims to provide a comprehensive framework for the broader digital asset market. Even former critics in Washington are acknowledging that stablecoins are a highly effective, superior technology for global payments.
Okay, but
The plumbing of global finance is irrevocably shifting to digital rails. An isolated hack on a specific decentralized perpetuals exchange does not invalidate the fact that base layer value settlement is rapidly and undeniably institutionalizing.
I understand the optimism around the Clarity Act, but you have to ask yourself, will that regulatory clarity actually protect the price of the asset?
It provides certainty.
It is highly probable that the passage of the Clarity Act will be a classic sell the news event. We've seen this repeatedly in financial markets. The market prices in the absolute best-case scenario leading up to a legislative vote.
That does happen.
Right. But by the time the legislation is actually passed, it is often a bipartisan compromise. It's so watered down with amendments and restrictions that it fails to protect holders from downside risk, while actively strangling the actual open-source innovation of the space.
I think that's a bit pessimistic.
Regulatory clarity doesn't fix the fact that Bitcoin is struggling to hold $60,000 today. It doesn't fix the daily massive ETF outflows. When technical support levels break, they break hard, regardless of what bills are being signed in Washington. We have to respect the invalidation levels of the market.
I think this is where we crystallize our fundamental difference in time horizons. My position remains that the structural 4-year cycle is completely intact. The supply shock mechanism is real and it's currently working its way through the system.
Slowly.
Yes, but it's happening. The institutional rails for massive 401k capital inflows are being actively laid down by the largest asset managers on the planet. Selling right now, during the mathematically predictable mid-cycle Bitcoin fall, means you are transferring generational wealth out of your hands and directly into the corporate treasuries of the permanent capital entities.
The entities that are supposedly buying.
That are aggressively buying this exact dip. The short-term macro volatility, the geopolitical noise, the temporary ETF outflows. These are all surface-level noise masking a profound structural accumulation phase.
And my position is that ignoring the noise is incredibly dangerous when the noise is a blaring siren. We are looking at breaking technicals at the vital $60,000 level. We are looking at massive, sustained capital flight from the ETFs.
Which we established is proxy flow.
But it still moves the market. And we are looking at severe geopolitical realities involving global shipping choke points that could trigger a massive energy crisis. When faced with those data points, capital preservation is the only rational, data-driven choice.
But preserving capital in a debasing fiat system carries its own risk.
The historical cycle model does not protect you from a 40% drawdown driven by a sudden global liquidity crunch. Selling now, preserving your capital, and waiting to re-enter the market at lower, technically sound levels is how you actually survive and thrive as an investor.
Ultimately, what we are both debating here is the fundamental approach to long-term risk management in an asset class that is, well, notorious for its volatility. For me, structural long-term risk management doesn't mean completely selling your position and trying to time the market. Right. It means managing exactly how you hold that position. It requires a barbell strategy, anchoring the vast majority of your portfolio in blue-chip digital assets like Bitcoin or Ethereum, while allocating much smaller portions to high-beta, venture-style protocols. That I can agree with.
And crucially, it mandates strict self-custody. The real systemic risk isn't a temporary 30% price drop. The real risk is leaving your assets on a centralized exchange or lending platform and suffering the fate of the Celsius or Voyager victims.
Absolute tragedy.
They lost everything because they didn't control their own private keys. If you hold your own keys in cold storage, you have the operational security to weather these geopolitical storms without panic selling.
I completely agree with you on the necessity of strict self-custody. That is non-negotiable in this space. But true long-term risk management must be dynamic. It requires respecting your technical invalidation levels.
Which you see at 60K.
Yes. If that $60,000 threshold breaks and the leverage is flushed out, dynamic risk mitigation dictates that you must be willing to rotate your portfolio into stablecoins. You cannot hold blindly through a 70% drawdown just because a calendar says the halving occurred a few months ago.
Stablecoins carry their own regulatory risks, though.
But you have to actively protect your principal capital. By stepping aside and preserving your liquidity in stablecoins, you ensure that you actually have powder dry to deploy when the true fundamental bottoms forms.
Well, when you see the Pentagon Pizza Index surging and global shipping lanes under threat, it is a stark reminder that these digital assets no longer exist in an isolated cryptographic vacuum.
They definitely do not.
They are fully tethered to the real world, actively reacting to war, monetary policy, and institutional behavior in real time. Analyzing both the underlying cyclical mathematics and these immediate looming macro threats isn't just an academic exercise. It is an absolute necessity for survival in this space.
Absolutely.
The question remains, is this current volatility a structural failure of the asset class, or is it the final brutal shakeout before the next massive run? Look at the underlying charts, weigh the institutional data, and decide where you stand.